Premium liability is one of the estimated liabilities, or those obligations which exist at the end of the reporting period, although their amount is not definite. In some cases, the due date is also not definite, and the exact payee cannot be determined or identified. Premiums are articles of value such as toys, household items, souvenirs, and other goods given to customers as a result of past sales or sales promotion activities. They are offered to customers in return for proof of purchase, such as product labels, wrappers, backstops, tokens, or coupons in order to increase the sale of products. To illustrate the accounting procedures involving premiums, let's consider this problem. Wonder Manufacturing Corporation sells certain merchandise for 900 pesos per unit. A mug costing 150 pesos is offered to customers upon the return of 5 wrappers plus a remittance of 30 pesos. It is estimated that 70% of the wrappers will be redeemed. During the first year, the entity sold 10,000 units of the merchandise, purchased 3,000 units of mugs, and redeemed 5,000 wrappers. Let's prepare the applicable journal entries for the transactions mentioned in the problem. It says here, during the first year, the entity sold 10,000 units of the merchandise. There is no mention as to whether the sales of the merchandise inventory are on account or on cash basis. So we assume cash basis. Therefore, to record the sales, debit cash and credit sales. For how much? 10,000 units sold multiplied by the selling price per unit of 900 pesos equals, another transaction to be recorded is the purchase of 3,000 units of mugs. Apparently, the mug is the premium, which is an asset upon purchase. So, to increase the asset premiums mugs, it must be debited. 3,000 units multiplied by the unit cost of 150 pesos equals 450,000 with a credit to cash for the same amount. Another transaction is the redemption of 5,000 wrappers. The second sentence of the problem reads, a mug costing 150 pesos is offered to customers upon the return of 5 wrappers plus a remittance of 30 pesos. When 5 wrappers of the merchandise are returned by a customer, he must pay 30 pesos to get a mug. Therefore, from the viewpoint of the entity, it increases its cash. So, debit cash. When the entity gives the mug to the customer, its asset account premium mugs decreases, right? Being an asset, to decrease, it must be credited. The question is, how much must be the debit to cash? 5,000 wrappers of the merchandise were redeemed. To get 1 mug, 5 wrappers are needed. So, 5,000 divided by 5 equals 1,000 mugs distributed to the customers. For each mug, the company receives 30 pesos. Therefore, 1,000 mugs multiplied by 30 pesos equals 30,000 total cash received. How about the amount to be credited here to premiums mugs? 1,000 mugs distributed, that is 5,000 divided by 5 multiplied by the purchase cost of 150 pesos equals 150,000. Notice that our total debit is not yet equal to the total credit. We must have a balancing figure here amounting to 120,000 to be debited to premium expense. The unit cost of a mug is 150 pesos, but the entity receives 30 pesos cash from every mug given to a customer. That means the net cost of a mug is 120 pesos. That is 150 minus 30. 120 pesos net cost or net expense per mug times 1,000 mugs equals 120,000 debit to premium expense. At the end of the accounting period, Wonder Manufacturing Corporation must record a liability for the remaining premiums estimated to be distributed in the future by crediting the account title estimated premium liability and debiting premium expense. Although the premiums or mugs have not yet been distributed, premium expense must already be recorded to comply with an accrual accounting principle you learned in your first accounting subject, the expense recognition principle or matching principle, which requires expense to be matched against the related revenue. The premium expense must be reported in the same period in which the corresponding revenue from the sale of the merchandise is earned. But how much is the estimated premium liability at the end of the first year? It says here, it is estimated that 70% of the wrappers will be redeemed. During the first year, the entity sold 10,000 units of the merchandise. Of course, we assume that for every unit of merchandise, there is only one wrapper. Therefore, with 10,000 units of product sold, went 10,000 wrappers to the hands of the customers, out of which 70% or 7,000 were expected to be redeemed. 5,000 wrappers were actually already redeemed during the first year, leaving 2,000 more expected to be redeemed in the future, that is after the first year. Since 5 wrappers are required in exchange for 1 premium or mug, 400 mugs are still expected to be distributed to the customers in the future. 400 mugs multiplied by the net cost of 120 pesos. That is 150 purchase cost minus 30 pesos amount of remittance from customer equals 48,000 debit to premium expense and credit to estimated premium liability. From the journal entries we have made, please notice something very important which you must always keep in mind. Premium expense and estimated premium liability are recorded at net cost. That is, purchase cost minus the amount of remittance or cash payment from customer. While the asset premiums is recorded at purchase cost. Kindly remember that. Now, another important matter you need to know is the proper financial statement classification of the accounts related to the premium, namely premium smugs, premium expense, and estimated premium liability. Premium smugs is shown under current assets in the statement of financial position. Estimated premium liability is a current liability, while premium expense is classified as distribution cost in the income statement or statement of comprehensive income. Premium expense is a distribution cost because, as you learned at the beginning of this lecture video, offering premiums to customers is a promotional activity intended to stimulate the sale of merchandise. The figures you see here, of course, are balances of these accounts arrived at by considering the journal entries we have made. For premiums, 450,000 debit minus 150,000 credit equals 300,000 debit balance. For premium expense, 120,000 debit plus 48,000 debit equals 168,000 debit balance. The estimated premium liability was affected by just one entry